Welcome, everyone. My name is Donna, and I'm your instructor for for Finance 351. You tell I teach a lot of accounting classes. Okay, this is going to be kind of awkward because I don't have anyone signed into our meeting tonight. But it's 7:15, and I thought I better get started. And I want to make a recording so that those that couldn't attend have something to watch. You should be able to see me on the screen, but you should also be able to see a blank Excel worksheet. I'm going to make this Excel worksheet kind of like our whiteboard in the classroom. Everything I write down on the screen will be saved into the workbook, and then I'm going to email the file out to all of you. So please don't worry about trying to watch the video and take notes at the same time. Everything important I talk about will be there on the spreadsheet. You might, as you get the spreadsheet and you download it and stuff, you might want to make some more notes to it or rewatch the video and then take notes on the spreadsheet. But the last thing I want you doing is spending time watching the video and trying to take notes at the same time, at least the first time through. So let's focus on what's important in chapters 1 and 2. And by the way, I hope to do this every week so that we can kind of have somewhat like lecture time, the way you would get in a classroom, that you can go back and watch that lecture 2 or 3 times, so that you don't feel like you're trying to just take that textbook and make it make sense. Finance is not an easy thing to learn, and like a lot of other disciplines, they use their own big fancy words for things. And sometimes if you can just take those big fancy words and turn them into plain English, the concepts aren't so bad, and they actually make kind of some sense. But you need an interpreter. So that's what I'm hoping I'm going to do. Not so much this week, but in future weeks, some of those chapters are full of scary looking math calculations. Please don't worry, we are going to use online calculators. We won't be doing the scary calculations in there, won't be using the formulas, but they're embedded in the chapter. So when I tell you to read the chapter, you're going to see the formulas. Don't freak out. When we talk next week about chapters 3, 4, and 9, if I've got my chapter numbers right, you know what, it might not be 3, 4, and 9, but I'll get you the numbers for them. Those are some of the chapters that get into some of the formulas, and I don't want you to worry. As when we go through it next week and have our lecture time, I will tell you how to use the calculators. We'll do some sample homework problems, and you'll feel much better after the lecture and feeling like I can do this stuff. So that's my whole rah-rah speech about feeling better and not worrying about things quite so much. Now I'm going to shut the video off and just talk. Okay, I also have open our textbook, and occasionally I'll be flipping the screen from showing you the Excel worksheet to a page in the textbook. So bear with me, sometimes I can get a little cumbersome. You're hearing a zillion clicks for me to get things set up, but we will hopefully make fairly smooth transitions. Chapter 1 didn't have a lot of, I hate to say it, lots of important stuff in it. It was a welcome to the field of finance. Finance is exciting and so on. I joke because every textbook has a chapter, usually it's chapter 1, that's an introduction to the topic. In this case, finance. What is finance? They're always trying to tell you why this book is going to teach you something really important. It's going to teach you this subject. If it's an economics class, they're going to tell you why economics is the most important thing you'll ever learn in your life. So this is finance. Sorry, I've been battling a cold. This is finance. So they're going to talk to you about why finance is so important and it's going to change your life. Now, just kind of read into it. That's the purpose of the chapter, to sell you on the subject so that you're excited to go on to the rest of the chapters. There are a few things in chapter 1, and I'm probably going to hit them more as we go through chapter 2 and refer back to them. But some of the things that we're going to look at is, what is a sole proprietorship? You may have heard this a zillion times in your other classes, so it won't be anything new. A partnership and a corporation. So what you need to do is know the characteristics of each and advantages, disadvantages. Maybe that's a good way to say it. In other words, why would someone choose to be a sole proprietorship? How is it good for them? How is it bad? They're thinking about it. All your business classes are going to touch on that topic in one way or another. Business law, of course, is going to talk about the legal aspects of each. Accounting is going to explain more and more how to keep track of the books for each kind of business. A finance class is going to cover a slightly different angle on it. So let's talk about what is finance. Because if you don't know where we're going or why we're doing this stuff, it makes each chapter a little bit harder to understand. So what is finance? It's how a business gets the money to start and keep going. Shouldn't be a question mark. Okay, how a business gets the money to start and keep going. How do they finance their business? If you think about it, people ask you questions like, how are you planning to finance that new car? So you've heard the word and you've used the word. With a business, they're talking about not just one purchase, like a car. They're talking about everything they're going to do. If it's a sole proprietor, there's not a whole lot of choices. The owner provides the money, or owner gets a loan for the money. That's really about all the choices you got in how a sole owner can finance his or her own business. A partnership, at least you've got the partners can provide the money or get a loan. So you've got multiple people. So if a business is running short and one partner doesn't have a lot more to contribute, maybe the other one can. So there's some balancing act of each partner has some strengths and you're sharing the load. With a corporation, more financing options. Owners so many things I want to say. I'm trying to figure out which one to say first. Owners contribute money by, okay, let's stop there. Owners contribute money. Well, in the case of corporations, owners are called stockholders. In a sole proprietorship, the person is called an owner. A partnership, you can call them an owner or a partner, but more often a partner. In a corporation, they're owners, but they get their own special term called stockholders. Sometimes you'll hear the word shareholders. They mean the same thing. I'm going to tend to use stockholders. So a corporation, the owners or the stockholders can contribute money, but how do they do that? The stockholders contribute money by buying the stock. So the corporation gets money when owners buy stock in the business and become stockholders. So a person decides, I want to become an owner in that company. It's a corporation, so the way they would become an owner is to buy stock. I'm going to move this characteristics and advantages and disadvantages down so we've got a little more space. Okay, what's unique about a corporation is that anybody can become an owner as long as the corporation is public, meaning it's offered its stock to the public. Some corporations are privately held. It means only a handful of people, maybe a family, different members of the family each own stock in the business. And they're the only owners, the only stockholders. So no one else can become an owner. But most corporations are publicly held, publicly traded. So somebody could become an owner by just saying, hey, I think I want to buy stock in that company. The company really doesn't get concerned whether that person's personality is, oh, we don't want them to become an owner. I don't get along with them. They're irritable. That would be really important if it was a partnership, because you have to work with that person. Partnerships usually only have a handful of people as owners. They're usually involved in the business, making decisions. And it's kind of like a marriage. You have to really trust and get along with that person, because decisions they make for the company you're stuck with, and vice versa. So a partnership, a new partner can't come in until all the other partners agree to let that person in. And sole proprietorship, by definition, is only one person. So we don't have the problem of a new person coming in. But with a corporation, stockholders aren't involved in everyday business most of the time. They buy stock in the business just to have an investment, to say they own part of the company. It might be an investment they make for their retirement, or just because they like buying stock and kind of play in the market. But they, as a stockholder, don't have the right to walk into headquarters and sit down at the corporate weekly briefing meetings and talking about, should we make a new model of this vehicle that we make? Should we stop selling Pontiacs, let's say, for General Motors? Just because you're a stockholder, you don't get to walk into that meeting. You don't have any operation power. You are a source of funding to the corporation. The corporation's real thrilled to have you as an owner because you brought money, but you don't bring decision-making power. The only power you have, well, it's very extensive. It's not in the way we typically think of having power. The stockholders get together or through mail vote, and they decide who the board of directors is going to be. Then the board of directors hires the people who are going to run the business. Management, who's going to be the president, who's going to be the CEO, and so on. And they can hire and fire them if they're not doing a good job. And the stockholders can basically fire the board of directors by voting them out. So the stockholders ultimately have a lot of power, but it's just so far removed. They're not in those day-to-day decisions about, what do you mean you're going to stop selling Pontiac? You know, and get into that discussion and whether you should own or shouldn't have. So, on my little spiel, that's probably most of chapter 1. Chapter 2 is a real important chapter because it's going to tell us a lot about accounting. So we're going to see accounting more than we're going to see finance in chapter 2. But to understand a company, you need to be able to read its financial statements. So I'm going to move our little sentence back up here so we've got some room. And we'll start talking about, yeah, if I could type. Told you, if I could only type. Chapter 2. Chapter 2 attempts to talk to us about financial statements of a company. And once you understand financial statements, then we can go on and talk about so many more things. And a lot of times financial statements will be in all the remaining chapters of the book. So thus, this is my speech to say, this is an important chapter and you want to pay attention. That'll make a whole lot more sense as we get into it. I'm going to do some homework type problems with you before we're done with this lecture. So hopefully you'll feel a lot better about what I'm going to talk about when we're all done with it. For a little while, it'll be almost impossible to figure out what I'm talking about and what page I must be on in chapter 2. Because I'm kind of going to back up and give you some background and give you some more simplified examples before I delve into things that are at the level they talk about in the chapter. That's my one complaint with this book, is that there should be some information you give the student before they read chapter 2, and they don't. So that's what I'm going to attempt to do first. Financial statements include an income statement, a balance sheet, and a statement of cash flows. I know those don't mean much to you right now, but what they are, think of them as 3 separate reports or sheets of paper. And those 3 sheets of paper, generally called the financial statements of a company. If you're an owner in a sole proprietorship, these don't mean as much to you. You're there every day. You know how things are going. You know that the number of customers who are calling you or placing orders with you isn't as good as it used to be. So there's probably nothing on these financial statements you didn't already know. A partner may or may not have involvement. There are sometimes some partners who don't get their hands dirty in the business as much. They don't get involved in as much. So they may get some benefit out of this, and others may be just like the sole proprietor. They know what's going on. They're there every day. With a corporation, remember we talked about stockholders aren't there every day. Generally, they're more removed from the business. So they want to find out, this business that they're a part owner of, is it still doing okay? Are they happy that they invested in it? Or is it time to maybe think about getting out of owning that business and moving on and buying stock in some other business? But the only way stockholders know what's going on is by someone telling them. And this is the way the company tells the stockholder what's going on. Quarterly, they put out financial statements, but officially, annually, a thing called an annual report is put out. Some of the pages of it are just glossy pictures of, look at our latest product, and we've built another factory here, and things are wonderful. And after all the glossy commercials, you finally get down to all of these financial statements in the annual report. These financial statements will tell the stockholder how the company's doing. So things you've got to be careful of if you're looking at an annual report of a company, and you will be as you prepare to write your paper for the end of the class. You're going to want to get annual reports for several years for the company that you've chosen. When you're looking at these, you will see in the annual report, so financial statements come in the annual report. Also in the annual report, sorry, I can't walk and talk at the same time, is the auditor's report, sometimes called the auditor's letter. The auditor writes a letter and says, we've looked over these financial statements and all the numbers in here are truthful. So when you see these financial statements say that last year we made $6 million in sales, that is the truth. The auditors verified it, and the sales really were $6 million. They weren't $12 million, they weren't $2 million, they really were $6 million. The financial statements might also say that the checking account balance is this much. If the financial statements say that, and the auditors looked it over and written their report, then that's really true. Something that's sometimes misunderstood is that the auditor's report doesn't, even though it might have a glowing report of everything in those financial statements is correct. We found no problems. By them saying they found no problems, some people read that as, this company is doing great. We found nothing to complain about. That's not the case. The auditor is only saying every number in here is truthful. Think of it as the gym. The local fitness center has scales for everybody to get on and see their weight loss and see how they're doing. And some inspector comes in and makes sure that no one's messing with the scales. The scales really do tell the honest truth about your weight. So the next person who comes in looks at the scale and they're standing on it, they're trying to see their weight, and they're like, Oh, that's the number, huh? It doesn't mean they're going to get a good number. They're going to get a number, and it's going to be the truth about what they weigh, but they've still got to look at that number and decide, is that good news or is that bad news? That's what we've got to do. We've got to look at the annual report for a company, look at all the financial statements, and for ourselves, judge, is this company doing well? Are they getting better? Are they getting worse? We have chapters that are coming up that will help us do that. For right now, we're just trying to understand in Chapter 2, what is a financial statement? What goes on and what do these numbers mean? We're not so much involved in interpreting them in this chapter. So be careful. It doesn't mean company is doing well. So the auditor's report is kind of neutral. It just says you can trust these financial statements. We're going to take each one of these financial statements and talk about them individually. What goes on it? How is it made? How is it different for a sole proprietorship? What would a partnership's income statement look like? Or a partnership's balance sheet? And how's that different from a sole proprietor's balance sheet? So we'll get a lot of building and looking at lots of different examples. I am going to start with the simplest and work towards the most complicated. We're going to start with the balance sheet, not because it's the order in which things are prepared, but I think it helps us understand everything else a little better. So I'm going to go to another sheet in our workbook here, and I try to blow up the font a little bit and the size of the worksheet so it makes a little more sense, and look at a balance sheet. We're going to do it for a sole proprietor. And to even make it less complicated, we're going to look at it for a service business. This means a business that doesn't sell a product. So if we keep it really simple, let's say that we've got a teenager who runs their own lawn and snow removal business. In the summer, they're mowing lawns and weed whacking and doing all that kind of stuff. And in the winter, they're taking care of sidewalks and shoveling driveways. So this person, this teenager who does this, is going to have a balance sheet. One of the things that goes on the balance sheet are assets. That's a term you're going to want to know. You're going to want to be able to recognize something as an asset. So if you looked up the definition of an asset, it would give you a big, long, sounding like it was written by a lawyer definition. Break it down into its simplest component. It is what the business owns. So the assets are what the business owns. And notice I said business. If this teenager has a really cool laptop that is not used at all for business, that's just for gaming, or they have a really cool game system in their bedroom, that's not going to go on their list of assets because that has nothing to do with the business. In accounting records, the business is kept separate from the owner. So when we make our list of assets, I'm not thinking about anything but the assets that are used and owned by the business. So some really obvious things this kid probably has is a lawnmower, shovels, probably snow shovels, a weed whacker. I know they probably have some fancy name for those things, but that's what I call them. Other supplies, maybe, it's really gotten sophisticated and is quite an entrepreneur, they have a vehicle. Let's see, what else would we have? Maybe there's a computer that is used for the business and a cell phone that they use for the business. So to me, those are some logical things that this lawn care snow removal business might have. other businesses are going to have different lists of things. If I was to look at his or her balance sheet and look at their list of assets, I may not see each one of these things separated. I may see the first three lumped together. Let's see how we can lump them together without taking a lot of time here. Let's do that and call them equipment. So you may not see a breakdown. You may just see them, the balance sheet saying equipment, supplies, vehicle, computer, and phone. So sometimes, even though there are lots of assets, what you're going to see on the balance sheet is categories, like supplies. I could probably break that down into all the different supplies. That's going to get a little tedious and make the balance sheet almost unusable because it's got so much listed on it that the lists are too long and too cumbersome to read. So when they break them down like this and into groups and categories, it makes it a little easier to understand and follow. But there are more assets that we don't tend to think of right away. Usually I'm doing this in class and I'm brainstorming and the class is all given ideas about what could possibly be an asset that this hypothetical business would have. And we always list the tangible things, but we forget that they probably have some cash. So you're going to see on balance sheets cash. Accounting-wise, cash really means what they have in the bank. There's checking, savings, any CDs they might have, and literal cash on hand. So it encompasses more than you might think. When you see the term cash, everyday language, we tend to think about bills and coins, stuff we put in our wallet, not necessarily what's at the bank or anywhere else. Accounting looks at it as everything's cash. Also, considering that this person does work for others, they probably have some insurance. To be very specific, we call it prepaid insurance because they only have something of value as long as the insurance policy is in effect. And insurance agents are not very good about letting you pay after the fact. They want their money, then they will cover you. So for a business, they might buy 6 months worth of insurance in one check. They write out a check, hand it to the insurance agent, and they're covered for the next 6 months. So while they have coverage, they've bought them and they've got 4 months left or whatever. It'll show up on the balance sheet as one of the things that they own. And another item that will be commonly seen is accounts receivable. This may or may not be a familiar term to you, so we'll put a little definition out here. It's the money owed to the business by the customers. Accounts receivable only come about when we, as the business, have done our part of the job. So we mowed their lawn for the month of October. They haven't paid us yet. So it's an account we're waiting to receive. If we haven't done our part of the bargain, even though we have an arrangement and in October I know I am going to mow their lawn, it doesn't go on here. It's only when we have earned it and we're still waiting to receive it that it goes on this list. So let's say that that is our list of assets. And I am going to take our lovely list of assets and move it over just a hair. Not like that. Don't you love the undo button? It saves me so much of the time. I think I'll just do this. It's easier. Okay, what I want to do, and typically this is done to the right, but because I have all my notes hanging off here to the right, I'm going to go over here to the left and put dollar amounts. Because when a business is asked to prepare a list of its assets, the person who asked them to prepare it, which is often the bank, they want to know not only what assets do you have, but how valuable are they? That can get a little tricky. You can probably put several values on some of this equipment. Do they want to know what you originally paid for it? You know, oh, I got my receipt. I can tell you when I bought that lawnmower, I spent this much money on the lawnmower. Or do they want to know what it's currently worth? If I look in the classifieds, the Craigslist, and found a lawnmower and said, oh, yep, that model lawnmower, 3 years old, it goes for this. That's the kind of the current going price for it, commonly called the market value of it. On the balance sheet, what you're going to see is a little different than either one of those. But I want you to hang tight with the rule for a minute. These are put down at their cost. So we go through the things that we purchased and we put them down at either how much we have, which cash is pretty easy. What's the balance in the checking account? How much do we have in CDs? Count what's in the drawer. Okay, I know how much cash I've got. So I'm making up this number, just saying we did all that and we found out how much we had. We know what we paid for the insurance. We know how many months are left not used up. And I'm going to say there was 4 months left. And it's $200 a month, so we'll put $800. Accounts receivable should be pretty easy to put a number by. Go to your calendar, go to any record-keeping system that you've got, and look at which customers still owe you money and how much they owe you. And total it up and put the amount here. So again, I'm making up a number. For some of these other ones, though, that were things we bought a while ago, we can put them down what they cost us, but that seems like kind of like lying. If I put the lawnmower down at the original price I paid for it, it's going to look a lot more valuable than what it's currently worth. And people might get the wrong impression about how wonderful stuff I've got. So while I say if we put it down at cost, I'm going to qualify that and say less depreciation. In other words, put it down at its cost, but take away the depreciation. So what is its subtotal after you take away depreciation? That is a more truthful amount that needs to be in the report. We're going to talk more about depreciation in a little bit, just to understand that over time, they drop the amount on the books. If I spent $2,500 for the lawnmower when I originally bought it, and I think it's going to last me 5 years or so. So let's look at the lawnmower. It cost me $2,500, expected to last 5 years. I am making numbers up. I don't really know about lawnmowers and whether they would last longer or more, but I'm going to say that $500 of it will depreciate every year. You see how I got the math? $2,500 spread over 5 years means that I figure I'm going to use up $500 of that lawnmower every year. So if I say the lawnmower is 3 years old, I will have used up 3 $500 chunks. So I'm expected, I say that I have depreciated $1,500 of that lawnmower. So I'm going to say that it's only $1,000 on the books now. Some balance sheets will tell the reader the original cost and the total depreciation that's happened so far. So the $1,500, and then show the $1,000. So they'll show how they got to the $1,000. Others will only show the $1,000, but then add a little footnote where the reader can read some stuff that came along with the financial statements and delve in and see all this detail. One way or another, they try to communicate to the reader that I have a lawnmower. It used to cost, when I bought it, it cost me $2,500, but it's $500 a year and it's 3 years old. So now it's down to $1,000. So hopefully that's making some sense and I'm not talking so fast that you can't understand me, which is a tendency since I'm sitting here alone. Okay, next thing. Once you do what we did with the lawnmowers, we can do it for all of these items. Depreciate them, figure out the depreciation, and put a number for each one. Supplies may not get depreciated because more than likely they're going to get used up before even a year happens. So they'll probably be put down at their cost. But let's pretend that we filled in all those items and we came up with a grand total of all of our assets of $20,000. And I'm thinking it might be smart for me to make a note for those of you who aren't looking at this and forget what I said. Let's do it here. Okay, what I'm trying to say is that when somebody looks back at this and says 1,000 plus 2,500 plus 800 plus 3,500, how did she get 20,000? We made the number up, just assuming that we filled in all the rest of them, and let's say it came out to 20,000. Because when we use examples, the last thing we want to do is come up with some example with some crazy number in it that makes the math hard. 20,000, nice round number, we can play with that one. Okay, the next thing that we're going to want to know on a balance sheet, besides what assets does our company have, are what liabilities does our company have. And again, liabilities has a big fancy legal sounding definition, but they're really what the business owes. They are its debts. Some things you got to think about when you're looking at this is, what does the business owe today? Not what are they going to owe in the future? Not what did they pay last month? If someone could go to your desk or wherever you keep all the mail that comes in with all the bills in it, for us it was a wicker basket. We have a lot of kids. When the kids were younger, paper was everywhere. It was just a safe place. Either one of us got the mail, it went into the wicker basket. So if I was looking for the bills, they didn't get lost. They were in the wicker basket. So if I were to try to make liabilities for my own personal life, I could go to the wicker basket and probably find every liability. So for our lawn care, snow removal business from this teenager, some of their liabilities would be a cell phone bill. We have to be careful with this one. Only if they haven't paid the current cell phone bill would there be a cell phone bill on the list. I know they have one every month because they have a cell phone. But if they're all paid up and there isn't a new bill yet, there's no amount owing at the moment. Knowing that there's going to be a bill next month doesn't have anything to do with today's list of liabilities. Let's say that they're making payments on that lawnmower. If it's 3 years old, let's hope they're not making payments. Let's find something else. The office computer. Maybe they bought that with a loan. They're still making payments. So you would list the computer loan. And they make a payment every month. This is going to sound totally contrary to what I just told you. But here, we're going to list the whole balance that's left to be paid on the computer. So let's say the computer loan still has $2,600 left to pay on it. That is the whole balance remaining on the loan. Okay. This one is only the unpaid bill. What we're doing is, what do we legally owe as of today? Even though you have an arrangement with whoever you finance the computer from, in the bank, that you would make monthly payments, legally you owe the whole $2,600 today. It is a debt that you owe the whole amount of. Technically on your cell phone, the only amount you owe is the current month, especially if you're not in one of the 2-year contracts or you can't get out of. If you're month by month, then whatever cell phone service you've used, you owe for. If you haven't used any, then that isn't yet a liability. I sure hope that made some sense. Let's say they have a credit card or a gas credit card, or the gas station, or just a generic Visa card. The credit card, it would be the whole balance. Just like the computer loan, even though they may only make payments each month on the credit card. So I'm trying to give this company a little bit of liabilities because obviously are really small and they're not going to have a lot. Sometimes you will see the liabilities listed a little differently than what we're seeing. So I'm just going to make a note here. Sometimes the liabilities are lumped together and called accounts payable. The person reading your balance sheet may not care about each individual small balance that you have. So they don't want you to list everything that you owe. $20 here, $40 here, $100 to the cell phone. They're just going to let you call them accounts payable. The longer term loan might be called notes payable. And if you owe on several notes, the promissory note you sign when you buy a car or get a loan is a formal legal document called a note that just says, I promise to pay you back. But they usually are for longer periods of time. So you might see these two things on the balance sheet, accounts payable and notes payable. And they're just a composite of the shorter and the longer term things that the company owes. We'll see some more liabilities as we stretch out to the fancier, bigger companies. But for right now, that's enough for us. So let's say that we have, if I can do some math here, $3,200 worth of liabilities. Too many I's in liabilities. Okay, so we have $20,000 of assets and $3,200 worth of liabilities. I'm just going to write that out. Assets, liabilities. Now I'm even going to use my fancy Excel skills here and do it this way so I don't have to retype them because I'll be lazy. Our assets are $20,000. Our liabilities are $3,200. I want you to think about what the bank's response would be if we walked in and asked for a loan. Do you think they'd give us a loan if we asked for $2,000? Probably most of you are thinking, yeah, I think they would. What if they asked for $30,000? Starting to feel a little unsure about that? Probably what you're finding yourself doing is comparing the $20,000 and the $3,200 and seeing if there's some cushion in between here. So you're subtracting the two. And I am going to use a very unaccounting word and saying if you took all your assets and used them to pay off all your liabilities, what would be left over? And as you can see, it's nearly $17,000. And who would it belong to? It belongs to the owner. Because if all the creditors, all the people you owe money to have been paid, you took the $20,000, you paid off these guys, the rest safely can go to the owner because every other obligation has been met. So the fancy accounting term for this is it's the owner's equity. $16,800 is the equity, particularly belonging to the owner. And since there's only one owner, it is that owner's equity in the business. This is called the accounting equation, and you're going to see it a lot. Assets minus liabilities equals, I'm going to shorten it and just say equity. You also can be said, or it can be as assets equal both of these are okay. They're the same formula, just twisted around a little. I would make sure that you're comfortable both ways. If it helps, go back up here and look at the second formula and play with these numbers. Assets, 20,000, equal the liabilities plus the equity. Yep, if I added those two together, I would get that. Okay, so it really does work. Just a new way to show the information. What's important out of what I just told you? I think you've got to keep coming back to that. What out of what she's saying do I need to know? I know how a student's mind thinks, and I would think the same way. So much information, what do I need to know? So let's make some what do I need to know? You need to know what an asset is. Recognize one when you see one. English teachers would probably have a fit with what I'm doing, but I'll explain what I mean in a second. Okay, so some really key points here, so we're going to highlight them and make them scream out at us. What we need to know. If I gave you a list of accounts payable, notes payable, vehicle, cell phone, cash, accounts receivable, you could pick through that list and say, oh, these ones are assets, that one's a liability. So in other words, could you put them in the right category if you were given the list of them? And then, could you use the accounting equation? Let me give you an example. If I told you assets were 15,000, equity was 10,000, what are the liabilities? That you could figure out the missing number by using this accounting equation. It might be that I give you equity and liabilities and don't tell you assets. So if I give you 2 out of the 3, could you find the missing one? Then you're on the right track. So be able to identify them and be able to manipulate the accounting equation to find a missing number. I know it's a lot of information. What I think I'm going to do is save this lecture. I know I have to talk about the income statement and the statement of cash flows, but if the lectures get too long, the file size is huge to upload. So I'm going to stop, save this one, start another one, and cover the last few topics. So you'll be looking for 2 recordings. And of course, I'll send you the file that goes along with them. So I'll be back with you in a few minutes.